You're watching a real trade on the Nasdaq futures. One contract. No scaling. No hedging. Just a clean decision. The idea was simple. Would price respect the 9 and 21 EMA, or was this structure about to break? And more importantly, would I manage risk properly or let the trade turn into a loss? Because sometimes the smartest trade is the one you don't lose money on. This trade was taken May 4, 2026, around 3:30 AM Pacific Standard Time, during the early session. A time where liquidity is thinner, moves can be cleaner, but also less forgiving. At this hour, price tends to respect structure more clearly, especially moving averages like the 9 EMA for short-term momentum, and the 21 EMA as a stronger dynamic support level. The plan was not complicated. I wasn't trying to predict the market. I was simply asking one question. Is price going to hold above these EMAs? Or is it going to break and shift momentum? The long position comes in as price is showing early signs of strength. You typically see higher lows forming, price staying above the 9 EMA, the 21 EMA acting as a secondary safety net. This is what we call a momentum continuation setup. But here's the key detail most traders miss. This is not a buy and hope trade. This is a conditional trade. Meaning, if EMAs hold, stay in. If EMAs fail, get out. No emotion. Just structure. Now this is where the trade actually becomes interesting. Price starts interacting with the EMAs. And this is the moment where most traders make mistakes. Because psychologically, this is uncomfortable. Price is not exploding in your favor. It starts slowing down. It might even dip toward your entry. This is where people start thinking, maybe I should just hold a bit longer. It might bounce. But the market doesn't reward hope. It rewards discipline. As price starts testing the EMAs repeatedly, you begin to notice something subtle. Momentum is weakening. Not collapsing, but weakening. This shows up as smaller candles, less aggressive buyers, more hesitation around the 9 EMA, price getting closer to the 21 EMA. This is the warning phase. And this is where your mindset matters more than your strategy. Because technically, the trade is still valid. But probabilistically, risk is increasing. Now comes the most important part of the trade. You're no longer asking, will this go up? You're asking, is this still worth the risk? And this is where your motto comes into play. Sometimes it's better to close at break-even than hold the loss. At this point, price action and momentum are clearly starting to weaken on the upside. The move is losing strength, and instead of continuation, there's a growing risk of a breakdown. This is exactly where risk management becomes critical. A logical step here is to cap the risk by defining the invalidation level, placing the stop loss at 27,806, which marks the range low. Because from a structural standpoint, if price breaks that range, it's no longer a pullback, it's a shift. And once that level fails, the probability increases significantly. That price could move lower aggressively. In that scenario, holding the trade would no longer be controlled risk. It would turn into unnecessary exposure. Because what happens next is predictable. If EMAs break cleanly, price doesn't just go a little against you. It accelerates. At this point, the trade is no longer showing strength. It's not failing aggressively yet. But it's not doing what it's supposed to do either. And that's enough. So the decision is made. Close the trade at break-even. No loss. No damage. No emotional baggage. And this is where most traders get it wrong. They think, I didn't make money, so it wasn't a good trade. But that's completely backwards. A break-even trade is not a failure. It's a position of control. You avoided Emotional attachment. Forced holding. Turning a small uncertainty into a confirmed loss. You respected structure. You respected your plan. And most importantly, you protected your capital. Because in trading, survival is the real edge. Let's talk about the alternative. If you held this trade hoping for a bounce, and price broke the exponential moving average decisively, you would likely see a quick move against your position, momentum shifting to sellers, a small scratch trade turning into a real loss. And now you're no longer trading. You're managing damage. This trade reinforces a few critical principles. EMA strategy is not about prediction, it's about reaction. Momentum matters more than entry price. A trade that doesn't work quickly is a warning sign. Break-even is a position of strength, not weakness. And most importantly, you don't get paid for being right. You get paid for managing risk. This wasn't a big win, but it was a perfectly executed trade. As you can clearly see, the price remained stuck in a tight range between 27,780 and 27,840. We had no way of knowing which side the price would ultimately break after that consolidation period. And over time, these are the trades that separate profitable traders from everyone else. Because anyone can hold a losing trade. But it takes discipline to walk away with nothing and call that a success. If you want more real trades like this, no hype, no fake profits, just real execution. Like, subscribe, and comment below. I'll break down more setups like this in detail.